Hello, everyone, and welcome to another week of Financial Education Fridays. This week, we're going to talk about why everyone needs to be an investor. Um, this here is going to be based upon, you can see these ideas and concepts in the books Rich Dad, Poor Dad by Robert Kiyosaki and The Cash Flow Quadrant by Robert Kiyosaki. I'll leave links to them as part of the post here. Um, these ideas are not new. Robert Kiyosaki just conceptualized them and put them in a book and created a business for himself out of it, being financial education. But these ideas have been around for a long, long time. The problem is that, when we go to school, we're not taught these ideas. I certainly wasn't. I had to I learned from just reading and searching. Okay. What I'm going to talk about this week is why everyone needs to be an investor. And to start with, let me change slides here. Okay, to start with, in the book, Robert Kiyosaki kind of breaks things down as there are employees, there are self-employed people, right? Those people who decide to go in, employed. Those are people who decide to go into business for themselves, such as dentists, okay, doctors. They have their own practices, chiropractors, your arts and crafts people, restaurant owners, all right? They work as employees and they get paid by somebody else. Then they go into a business, then they start their own business, and really they're an employee in their own business, okay? And then you have actual business owners, right? And these people are the people who, when you think about it, let's say somebody owns 12 McDonald's franchises. Well, they're business owners, okay? Um, they have other people running the businesses, right? And then the last thing that he has is investors, okay? And this is where everybody needs to be, all right here, right? Why? Employees, you're working for a paycheck. Self-employed, you're still working for that paycheck, but you're doing it for yourself. Yeah, business owners, you know, you're having other people work for you, but you have to uh, oversee them and manage them. Um, and investors, this is where your money makes money. A Your money makes money. Okay. This is where you put your money in, it frees up your time to be able to do other things. And while your money is in that investment, um, theoretically, you're making money. Sure, there's a chance of loss, but in any of these, okay, there are advantages and there are disadvantages. Okay, it's just how you see them. Um, I've heard of people who have been employees, like the guy worked for UPS and all he did was, so he worked, he was an employee and he took the extra money out of his paycheck and was an investor, stuck in investing. And it's the same thing with self-employed. All right, business owners have a tendency to make more money, so they have more money to invest, but they're so um, busy managing their business, all right, that they oftentimes don't invest, or they invest in like businesses. Okay, but the whole idea here is as I said, why we need to be investors. I'll go into these concepts and ideas a little bit in future videos, but for now, just get the idea that from the book Rich Dad Poor Dad and the Cash Flow Quadrant, he breaks down um, how people make money into these four different categories. Okay, now without going into financial accounting, all right, um, we all know that if this is all part of the financial education, so I'm going to try and keep this somewhat simple as possible. We have assets and then we take out our liabilities, which leaves us our equity. Okay, assets are things we own, you know, like cars and houses and stuff like that. Liabilities are things we owe, like bank loans and mortgage payments. And equity is the difference between the two. That's, you know, commonly called net worth, right? Now, there's also revenues and expenses, which gives us a profit or a loss. Okay, now what happens here is, and this is why you need to be an investor. Okay, when I'm an employee, okay, when I'm an employee, all right, I make a paycheck. That's my revenues. Okay, then you have to pay, you know, your mortgage, your rent, your car payment, your food, your bills. These are all your expenses. Okay, and what you have left over is your profit or loss. It's, you know, your spendable income at the end of the month, right? And what ends up happening is um, people will either just save that, right? Now that profit or loss is cash, and that can end up here as an asset because you're increasing your cash. But cash just sitting there doesn't do anything for itself. It's not money making money. It's just money sitting in your bank account if you're saving it. And at low interest rates where we are, you know, you're not getting, you know, inflation is outstripping whatever you get as a return on your investment by quote unquote collecting interest as it sits in your savings account. So that's a poor use of your cash. Okay, it's a poor use of that profit or loss. Right? But the idea being here is that, you know, you have money coming in to your revenues, and then you have money going out in your expenses, and you can't, you know, you can't get ahead like that. Anything that you, I mean, think about it. If you want to retire at the age of 50, and I mean, sorry, at the age of 60, and you're 50 years old, you know, you have to make, is keeping with this scheme, you have to make twice as much money as you are now. And even if you do over that 10 years, that means you only have enough income to last until you're 70, right? Because you're 50, you want to retire at 60, you're doubling everything, right? Well, that's 10-year difference. That means if you retire at 60, you can only, you know, have enough cash to be able to live till 70. I mean, and we're talking about doubling your income already. All right, you can't. It's not that easy to just double your income overnight. All right. Yeah, you're gonna have, you know, that spendable cash out of your profit and loss. Let's say it's 10%. Okay. I mean, you know, if you're 50 and you're only saving 10%, you know, it's not enough to get you to the age of 70, let alone 80 or 85, which is right now the average age that, you know, people live in the United States. So we have revenues coming in, expenses going out. Doesn't help us. Okay. Think about the self-employed people. You know, they're the same thing. You know, they have their revenues coming in and their expenses going out. Right? Business owners, the same thing. Okay, except they get more involved in things like liabilities. In that, yeah, they own a business. Okay, and they consider that an asset, and then they end up taking out their liabilities. Okay, they have to pay, you know, whatever loans they have and things like that. And while that business is generating revenues and they do have expenses coming out, they still end up with just their profit and loss, which is cash, and they put it back up here into cash. Okay, which now leaves us down to, you know, what does an investor do? Okay, what an investor does is he goes and he buys assets. Okay, so whatever he's doing, whether he's employed, self-employed, or as a business owner, he has this spendable cash, right, from the profit and loss. And instead of just letting it sit up here in cash or spending it, he actually goes and he buys these here assets. Okay, and he lets the assets make money for him. He lets money make money. So let's just take a quick look at that. Let me go over here, get a new slide. So assets, right? So he takes his cash, and what does he do with it? He doesn't leave it in cash, okay? He comes over and, I mean, today, you do have to study and you do have to learn in order to be an investor. You can't just take your cash and then turn it over to a 401k, okay? You're going to lose money. You don't turn it over to a mutual fund, all right? You're going to lose money, all right? It's not to say that these aren't valid instruments, financial instruments, just that they're very, very poor instruments that because those who are not financially educated, who don't know how to invest, they don't have any other choice. They're sitting there saying, well, in the 401k, the company's matching my input with say 30%. Okay, well that's better than it's sitting in cash, obviously, unless whoever's managing the 401k is running at a loss. Okay, doesn't matter how much money you're putting in. If you're losing money, you're losing money, period. What you're doing here is saying, is he losing more than 30%, right? Which in a lot of cases they are. Okay, and the same with mutual funds. You have things like stocks, bonds, right? Real estate. Those are the common ones. But the idea here is when you're investing in an asset, what you're looking to do is two things. You're looking for appreciation, or you're looking for cash flow. Okay, and if you can get both, so much the better. Okay, appreciation, what's that? Well, that's you've heard of buy low and sell high. That's appreciation. Okay, cash flow that's where the real money is being made, in that you invest in the asset, and then that asset is throwing off the cash. Okay, a simple idea behind that. Let's say you buy a stock, okay, a blue chip stock, and they pay a dividend. Okay, well, whoops, sorry about the spelling. Right, they pay a dividend. Well, on that stock can appreciate in value. Okay, why? Because you can buy it for say $100 and it can go up to 150, right? So you're making $50 in profit. That's appreciation. But that stock could also be throwing off a dividend, say $1 per share, and if you have 1,000 shares, right, that's $1,000. That's your money sitting in the stock is throwing off the money making money, and that's cash flow. Okay, this here idea behind the stock, that's just one example. Real estate is another. I mean, we've all heard about, how in real estate you're going to buy, and then the people pay down, whoever's renting that single family home, you're using that rent to pay off the mortgage, and the extra cash is cash flow. Okay, that's a very valid idea. All right. But different investment vehicles are for different people. I mean, me personally, I don't like real estate. Okay, it's just that simple. I'm one for more like paper assets with stocks and things like that. That's more akin to me. All right, but you don't just start by just saying, okay, I have extra cash from, at the end of my paycheck or my end of my month, and I'm just going to buy stocks nilly-willy. Okay, or I'm going to just stick in real estate. You have to spend the time learning about uh, the investment vehicles, and to see which one is right for you. And you have to, I mean, it does take study. Otherwise, you're going to lose that money. You're better off, so you have this situation where I get a paycheck, I pay my expenses, I have extra cash. Well, I might as well go on a trip. Because why? At least I'm going to enjoy it, versus I'm going to stick it in the market and lose it, right? At least I get the enjoyment out of it. But in either case, what's happening is you're not able to save that money for retirement to be able to meet your needs later on down the road. Okay. So that's why everybody needs to be an investor. All right, they need to be able to take that money and have the money make money in order for the future. All right. So this is 15 minutes in this video, and I'll touch upon, what I think I'm going to do is in the future, I'm going to explore these ideas a little bit more. Like I said, I'm going to put links up for the Rich Dad Poor Dad and the Cash Flow Quadrant books by Robert Kiyosaki in the post. Get them, read them. It's a good direction to head. But in the future, I'll try to discuss more of these ideas. And if anybody has any questions or any thoughts, feel free to post them. And I'll respond to them in the videos or whatever have you. But again, we're going back to this here idea of, why everyone needs to be an investor. You know, if you're just going to work for money the rest of your life, that's exactly what you're going to be doing is working for money. Okay. Investors who know how to have money make money for themselves, they're the ones that become financially free. All right. So that's it for now. And, I hope you have a good week until I see you next time. All right. Thanks.